Okay, let's dive right into this explainer and see if we can uncover what is essentially the holy grail of investing: generating stable, ethical returns without losing sleep every time the market gets a little choppy. Today, we're unpacking a really fascinating piece of research that details the performance of an absolute heavyweight in the Malaysian market. We're talking about KLCC Property Holdings Berhad, and specifically is Sharia-compliant real estate investment trust. Seriously, if you've ever found yourself wondering exactly how massive institutional wealth preserves its capital while practically printing consistent income, well, you're about to see exactly how they do it.
Here's our quick roadmap for today's explainer. We'll start with what is KLC REIT, then look at the technical picture, move on to crunching the numbers, examine the macroeconomic impact, and finally wrap up with the final verdict. Let's just jump straight in. Section 1. What is KLCC REIT? Or as we like to call it, the financial fortress. So first things first, this isn't just your standard run-of-the-mill property fund. Not at all. This is an IREIT, an Islamic real estate investment trust. And what that means is it ensures your capital is ethically shielded from prohibited elements, things like excessive uncertainty, gambling, or interest. In Islamic finance, those are known as gharar, maisir, and riba. By using mechanisms like takaful insurance and going through incredibly strict securities commission screenings, it creates a profoundly safe, fully compliant foundation for the investment. It's really about peace of mind.
And the sheer scale of this thing? It is literally legendary. Listed on Bursa Malaysia under the ticker 5335SS, it is the single largest Malaysian Islamic REIT by asset size. We're talking a portfolio of Grade A prime commercial real estate, the Petronas Twin Towers, Menara ExxonMobil, the Surya KLCC Mall. That is an estimated 5.6 million square feet of net lettable area. Plus, it operates as a staple security, which just means every REIT unit is inextricably glued to an ordinary share of the property company, and the whole operation is completely anchored by high-credit tenants, like Petronas, locked into long-duration leases. But here is the absolute best part if you're an income investor. To keep its tax-exempt status under the Malaysian Income Tax Act, KLCC REIT is legally obligated to pay out a minimum of 90% of its distributable profits to unit holders. Let that sink in. 90%. This single regulatory rule essentially forces this financial fortress to constantly funnel cash straight into the pockets of its investors, typically every single quarter.
Section 2. The technical picture. Let's see what reading the charts can tell us.
So take a look at this 50 trading day consolidation pattern. What we're seeing here is a classic neutral to bullish signal. The price has tried to push upward a couple of times, but right now, it's just taking a breather as momentum slightly fades. But notice the formation of higher lows. That tells us that buyers are steadily soaking up the available supply. The market isn't giving up. It's just essentially waiting for a clear catalyst to make its next move.
To evaluate this kind of trade safely, you really have to map out your boundaries. The data clearly shows buyers are aggressively defending the RM937 and RM925 floors, so those are your key support levels, your safety nets. On the flip side, though, the stock is struggling right now to punch through that RM95020 ceiling, which is acting as a major point of resistance. And that brings us to a crucial point. Breakouts require heavy conviction. Right now, the trading volume is pretty sporadic. That tells us the large institutional money is mostly just hanging out on the sidelines, waiting. We're going to need a massive surge in trading volume to convincingly break through that RM9.520 resistance ceiling. Until that volume actually shows up, investors are smart to rely on stop-loss orders to navigate this sideways market safely. Section 3. Crunching the numbers. Charts are great, but let's open the books. Let's begin with return on equity, or ROE. This is essentially the ultimate test of a management team's efficiency with your money. It tells us precisely how well the company takes the capital invested by shareholders and transforms it into cold, hard, tangible net profit. And the numbers we found are fantastic. KLCC REIT's ROE jumped to an impressive 9.05% in 2025. That's up from 7.71% the previous year. This leap was fueled by a net income of 1.283 billion ringgit. It absolutely proves they are masterfully channeling earnings into higher dividends, which is being driven by upgraded property appraisals and really stable revenues across all their divisions: hotel, retail, and office. Next up, we look at valuation through the price-to-earnings, or PE ratio. The PE ratio is a great shortcut. It tells you exactly how much the market is willing to pay today for a single ringgit of tomorrow's earnings. Sitting at 22.44 times, the market is clearly demonstrating very high optimism here. Investors are willing to pay a premium,
And why wouldn't they? They're treating this asset exactly for what it is, a highly defensive, income-producing instrument with incredibly reliable, long-lasting earnings capacity. It's a safe bet, and the market knows it. All right, let's move to the metric that builds into what income investors care about most, the dividend yield. This is the big one. It's what every income investor is hunting for. It is the actual, straightforward cash-on-cash return you receive, totally separate from the stressful daily price swings of the stock market.
And KLCC REIT is delivering a rock-solid 5.15% yield. This is driven by a record 47-cent payout per stapled security, which is actually up 5.6% from the previous year. You see, this is the tangible, real-world reward of having those grade A properties funneling reliable rent directly to you. It doesn't get much better than that.
But hold on a second. High yields can be dangerous if they're funded by reckless borrowing, right? That brings us to the debt-to-equity ratio. In a world of fluctuating interest rates, excessive debt is the natural enemy of real estate. That is exactly why we absolutely must check their leverage to see how all these operations are actually being funded.
Well, you can breathe easy. The source data reveals a beautifully conservative DE ratio of just 0.36 times, or 35.71%. Not only is this way below the Securities Commission's 50% regulatory cap for Islamic capital market products, but it also means this fortress is primarily funded by equity, not debt. This low financial risk makes the fund practically immune to the dangers of rising interest rates, giving them massive financial flexibility.
Section 4. The macroeconomic impact. Let's see how they go about weathering the storm.
Let's look at the broader monetary policy first. Because Bank Negara Malaysia kept the overnight policy rate, or OPR, unchanged in 2026, KLCC REIT remains far more attractive than standard fixed income assets. Since REITs are naturally sensitive to interest rates, an unchanged, stable OPR keeps borrowing costs down and keeps institutional demand heavily anchored to the REIT's superior dividend yield. But what about inflation and economic growth? Well, even if inflation ticks up, KLCC REIT uses long-term, triple-net leases as a shield. These leases have built-in escalation clauses that pass operating costs straight on to the tenants. Brilliant, right? Meanwhile, any overall GDP growth directly fuels consumer spending, boosting the retail turnover rent at their massive Surya KLCC mall. And finally, a stable rate environment supports corporate profits, which in turn sustains high occupancy demand for those stunning grade A office spaces. All of this dynamic triggers a really fascinating psychological shift in large-scale capital reallocation. Based on behavioral finance, when the broader market panics or sentiment just weakens, the heavy institutional hitters, funds like the EPF, PNB, and KWAP, instinctively seek safety. They reallocate their funds right back into the highly defensive, asset-light, and fundamentally secure walls of KLCC REIT. And that influx of big money limits downside risk and stabilizes the price for everyone else.
Section 5. The final verdict. The defensive anchor.
Looking at all of this, the source material makes an incredibly compelling case. KLCC REIT proves that meticulous capital management, a remarkably low debt ratio of just 35.71%, and prime grade A Sharia-compliant assets can weather almost any storm you throw at them. While the technical charts show some short-term consolidation, waiting on volume, the fundamentals offer a deeply safe 5.15% yielding haven. It really leaves us to wonder, as macroeconomic winds inevitably continue to shift, is your own portfolio adequately fortified for the next economic storm?